G'day. So let's talk a little bit about property taxes. So property is one of the most highly taxed things in this country. It's just a consequence of making money. Let's have a little bit of a conversation around what land tax is and other taxes associated with property. I'll run you through some of the calculations and how you can potentially be minimizing your land tax moving forwards. So when we buy property, we pay stamp duty, which is basically a transfer tax. It goes to the state government on the basis of you acquiring a particular property. Typically, there's a calculation, but it's around about 4%. I'll share with you a screenshot calculating the numbers. We usually budget for about 5% total when you're buying a property, which takes into account real estate agents' fees, transfer fees, legal fees, so on and so forth. So usually we budget about 5%. Now, land tax is calculated based on the properties that you own and the land value. And that land value is determined by the government. And each year they will do an assessment of that. And if you are over the threshold, then you will pay tax anywhere between 1.6 and 2% of the value of that land. Now, the interesting thing is, depending on where you are living, there is a threshold. I believe Canberra and the Northern Territory, if I'm not mistaken, have no land tax threshold, meaning that you pay tax on any land that you hold from $0. And most other states have a threshold. Let me just show you New South Wales. Okay, so firstly, let's have a look at the general threshold for the 2024 tax year. It's $1,075,000 in New South Wales. There's also what's referred to as a premium threshold. And basically what that means is if you're in the general threshold, you pay $100 plus 1.6% of the land value above the threshold up to the premium threshold. And if you're at the premium threshold, you pay $88,000 plus 2% for anything that's over the threshold. Now, aside from Victoria, if you're a resident of Victoria, I believe this is no longer the case, but if you're a resident of New South Wales, Queensland, basically the other states, each state has a state-by-state threshold for land tax, meaning that you could accumulate property that has, say, a land value of $1 million in New South Wales, around about the same in Queensland, and also the other states, basically avoiding land tax altogether. For many of our clients, they look to invest interstate as we approach this threshold, assuming that it makes sense. In saying that, if we accumulating good property and we've got good liquidity and we've planned for the tax that we're going to need to pay, trying to avoid land tax at the detriment of wealth building is not necessarily a great idea. It's a consequence of making money. It just is something that we've just got to consider. Taxes are most painful when either we don't expect them or we haven't planned. Now, the other consideration is depending on the entity that you are using to acquire that property, whether it be a trust, a company, there are different assessment criteria for land tax, typically meaning that there is either no threshold or a reduced threshold for land tax. So what that basically means is that if you are taking advantage of those entities, you need to make sure that you've got specialist advice, because for many people, by using those entities to try and optimize or minimize their tax or protect their assets, they are potentially going to incur additional costs by way of land tax. So you've really got to factor that into your cost benefit analysis. You've got to make sure you get expert advice from a great accountant or a tax lawyer to ensure that they can make sure you structure that appropriately.